Is your money stuck in a trade right now? Or did you just lose some? You buy it drops, you sell it rips, you wait it drops more. Here's the thing, this isn't a skill problem. Nobody ever taught you the real stuff. I'm Moon. I've spent years obsessing over one thing: the footprints institutions leave on a chart right before they move money. Nvidia, Meta, Apple. Every single one of these stocks before they exploded showed the exact same signal first. In this video, you're going to learn the 3 chart patterns pros use for their entire career. If you don't know these, you're handing your wealth over to institutions every single day. Why should you watch this video? Simple. Right now, 90% of retail investors in the US stock market are losing money. That's from a JP Morgan research report. 2024, 90%. Here's what's crazy: the tools that 90% use and the tools that the winning 10% use. They're identical. Same charts, same candlesticks. The only difference, which patterns they're looking at. See, this pattern, enter here, exit here. That's literally it. If you've ever stared at a chart and had no idea what to look for, or every time you enter a trade, it goes against you, hit subscribe, and if this video helps you, drop a like too. Let's get into it. Today we're covering exactly 3 things. Where does money come from and where does it go? Where institutions are actually putting their capital right now. Who's really moving the market? Why retail loses when they buy and wins when institutions buy? So, where do you invest? The exact 3 patterns where that flow shows up on the chart. Real quick, let's get one thing straight. $400 billion flows through the US stock market every single day. Of that, 75 to 80% is institutions, hedge funds, quant funds, market makers. Retail, we're 20%. Now think about what that actually means. For every $5 moving in this market, 4 of those dollars are being controlled by people who do this professionally, full-time, with algorithms, risk desks, and decades of data behind them. And we're sitting here trying to compete with a Robinhood account and a YouTube video. That's not me being harsh, that's the reality. But here's the thing, and this is the part most people miss wherever institutions buy and sell. It leaves a mark on the chart. Every single candle is an institutional footprint. Think of it like a crime scene. The money already moved, but the footprints are still there. Follow the footprints you find where the money went. The chart is those footprints. And what most people don't realize is there's a specific way to read them. You're not looking at every candle. You're looking for 3 specific patterns. The same 3 patterns pros have been using for decades. Let me show you. This is where it gets good. Pattern 1, the cup and handle. William O'Neill identified this in How to Make Money in Stocks. Nearly every major winner in S&P 500 history formed this pattern before it exploded. Here's the shape. Stock moves up, pulls back in a U shape, then recovers. That's the cup. Then it tightens slightly, a small pullback. That's the handle. When the handle breaks above the prior high, that's your buy signal. Look at Nvidia. January to May 2023 textbook cup and handle. Cup formed around $180. Handle held near $270. When it broke out in May, it hit over $400 within a month. That's 150%. Now you're probably thinking, easy to see in hindsight. How do I catch it in real time? Volume. That's your confirmation. Volume should shrink while the cup and handle form. Think of it like a spring getting compressed. The less activity there is, the more pressure is building underneath. Then when it breaks out, volume needs to spike at least 1.5 times the average. That's not a guess anymore. That's confirmation. That's institution stepping in, and that's your green light. Pattern 2, the bull flag. This one's the most popular with short-term traders. It looks exactly like a flag on a pole. Stock surges hard and fast. That's the flagpole. Then it drifts sideways or slightly lower in a tight range. That's the flag. When the upper edge of the flag breaks, you buy. Why does it work? When a stock jumps 10%, profit takers come in. I'm already up, let me cash out, and they sell. That selling creates the flag. But here's the key. If the stock barely drops despite all that selling, it means someone bigger is absorbing every share. Picture an ocean wave crashing onto the beach. The wave hits, that's the surge. The water pulls back slightly, that's the flag. But notice the waterline doesn't go all the way back. It holds higher than before. That's institutions holding the floor. And once they've absorbed everything retail is dumping, the next wave comes and it goes higher. Meta, March 2024. Flagpole from $480 to $530. Flag pulled back to $510. Broke $530. 2 months later, over $600. Entry at $530, $10,000 invested, you made $1,300 for reading a chart for 10 minutes. Pattern 3, the simplest one and the most ignored. The base breakout. A stock trades in a tight range for weeks or months, stuck between the same support and resistance levels. Volume gradually dries up. Then it breaks above that range. That's the start of the real move. Why does it go up? While that stock was going nowhere, institutions were quietly accumulating shares. Every time retail sold out of boredom, institutions bought. Every time retail sold out of fear, institutions bought. Once they had enough, they pushed it up. Accumulation, markup, distribution. That cycle has repeated in every market in every era forever. Apple, late 2023. Tight range between $170 and $180 for 2 months. Volume drying up the whole time. Then it broke $182 in December, hit $198 within a month. $50,000 in at $182, you walked out with $54,350. So here's the question nobody asks. If these patterns are this clear, why is 90% of retail still losing? Because when the signal fires, your brain does something predictable. It says it already ran. What if I buy right at the top? What if this is the one time it doesn't work? That's loss aversion. Humans are psychologically wired to fear losses twice as intensely as we want equivalent gains. That's from Daniel Kahneman, Nobel Prize in Economics. It's not weakness, it's biology. But in trading, that biological instinct is working directly against you. The fear that's supposed to protect you is the exact thing that keeps you on the sideline while the trade you spotted moves 20% without you. Here's what separates the pros. They don't try to silence that fear. They remove the decision. When the pattern shows up, they enter. No hesitation. Because the stop loss is already set before they touch the buy button. Cup and handle stop 5% below the handle low. Bull flag stop 3% below the flag low. Base breakout stop 4% below the breakout level. If price hits that level, they exit. No debate. No, let me just wait one more candle. The difference between pros and everyone else isn't the pattern knowledge. It's whether or not they honor their stop. Let's bring it all together. The chart is an institutional footprint. Every big move leaves a trail. And these 3 patterns are how you read it. Cup and handle, accumulation building pressure, then release. Bull flag institutions absorbing the dip, then pushing higher. Base breakouts, weeks of quiet collection, then the real move begins. Learn all 3. Set your stops. Get out of your own way. I'll be straight with you, knowing this isn't enough on its own. You have to pull up charts and practice. The first few times you'll second guess yourself. That's fine. Do it anyway. Because the 10th time you spot a bull flag forming in real time and you enter and it works, that's when it clicks. And you never go back. I'm not making this content so you can keep chasing stock tips and watch your wealth slowly disappear. I want you to read charts yourself, make your own calls, and protect and grow what you've built. If this video helped, drop a like. It genuinely matters. Not subscribed yet? Now's the time. I'm Moon. See you in the next one.